Welcome to Trading Day. I'm Roger Peterson. Thank you very much for joining us. Joining us later this hour is the CEO and founder of GFL Environmental, Patrick Dovigi. Dovigi will walk us through the quarter and outline how GFL is setting itself up for the year ahead. And let's get to some of the stories we're following in the BNN Bloomberg newsroom. Canada's economy posted modest growth in February. Data from StatsCan showing GDP rose 0.2% in line with expectations, and it follows a smaller gain in January. The increase was driven by strength in goods-producing industries, including manufacturing. Early estimates suggest growth stalled in March. We've got some perspective on that from one economist.
GDP was basically flat in the month, that there was no change. But it's hard to tell if that's an oil price story or if that's, just something that we're seeing, with the sort of conflicting forces in the data and in the economy. So 1 month doesn't necessarily make a trend, but certainly we will start to see the impact of that oil price shock starting to show up pretty materially in the GDP data, as we have already with inflation.
Shares of Bombardier are seeing a surge after the jet maker posted stronger first quarter results with both profit and revenue up from a year ago. The company says the results were driven by deliveries as well as strong demand for maintenance and support work. Bombardier also saw a sharp rebound in free cash flow and raised its full-year outlook. Shares of Gildan Activewear are trading higher, up 9.4%. The apparel company posting first quarter results that beat expectations and saw revenue come in at a record $1.2 billion. Gildan says the integration of its Hanes Brands acquisition is on track with higher savings expected this year. It is also maintaining its full-year outlook. And a quick look at the markets. The TSX bouncing back nicely. Look at that. It's up 1.4%. It's being led by consumer discretionary, healthcare, industrials. Only two are in the red, real estate and tech, and they're almost at the plus side. And the U.S. markets, quick look at them. And similar situation, nice rally going on there for the Dow and the S&P 500. The S&P 500 up by a half, the Dow 1.39, and NASDAQ's in the green, but only by 0.2. All right, as Ottawa looks to push more capital toward the Canadian economy through the Canada Strong Fund, our next guest is warning investors it could signal new scams. Here to talk about that and other market trends is Maile Wong, Senior Wealth Advisor and Senior Portfolio Manager at Wellington Altus Private Wealth. Well, hopefully some profit too, Maile. Thank you very much for joining us today.
Hello, Roger. Thanks for having me here today.
What are some of the concerns with the fund?
Well, I think first and foremost, this Canada Strong Fund does represent our Prime Minister Carney's view that we're at a really critical moment in Canada where we need to really demonstrate our economic independence and security. And so creating this fund is really in alignment with that view. And I would look at it as wartime spending at this critical juncture. And essentially, this is a little bit different than some of the other sovereign wealth funds that exist globally in the fact that we are using debt to create this fund, and therefore a return on investment higher than the cost of capital will be warranted. But for investors in particular, I will highlight that there are some risks around some of the scams that we've seen a few months ago. Roger, you may recall when there were some deepfake scams of Mark Carney advertising various different investment opportunities that were not even real. And so now we have a situation where the Prime Minister is talking about an investment that retail investors can participate in to support Canada's investment in infrastructure. And so the details are still yet to come out, but I think that's something to be really careful about and make sure you investigate whether this is real or not, and therefore look for details and verify with an advisor.
Is there a lot of interest from retail investors with this?
I think it's still too early days. One of the things that we look at is the fact that infrastructure can be a good diversifier for a portfolio, but liquidity is key. For retail investors, having cash flow from an investment, something that is often very desirable. And if the investment in this Canada Strong Fund is a very long-term investment, i.e., 5 years plus, investors need to think about if this is a good fit in their overall portfolio. And therefore, the proportion and the dollar amount invested will be, again, dependent on the details that are still yet to come.
Always, the devil's always in the details. Let's get on the Bank of Canada Fed rate decisions. Just want to get some quick reaction to that. No real surprise. They held the line.
That's right. Both Bank of Canada and the Federal Reserve held the line this week, keeping rates unchanged. And I think part of what's really interesting in the Bank of Canada's, what they're looking at is this. They're both in the same kind of bind, Bank of Canada and the Federal Reserve. They're looking at oil prices and inflation and what that might mean over the next 6 to 12 months in terms of the inflationary trend, balancing that off with also still relatively slow economic growth, where stimulus might be required. So these two balancing acts are really important that both the Fed and the Central Bank of Canada are looking at today.
And with the GDP numbers we're seeing today, what kind of a role might that play in that decision? Your thoughts on what we saw today, and are we heading in the right direction?
Yeah, so Canada's GDP growth was fairly muted, month over month, 0.2%, pretty flat, and an already below trend GDP number. So in Canada's situation, we really are looking to just try to stimulate some growth, especially with these longer term inflationary impacts potentially arising from the conflict that's existing in the Middle East. The U.S., on the other hand, their quarter over quarter annualized GDP growth rate was pretty robust at around 2%. And that's where it's really being driven by the strong U.S. consumer and business investment, in particular AI investment.
AI is everywhere. And it's a good segue into some of the earnings. What we saw yesterday after the bell, for the most part, good, but not everybody happy.
That's right. This week is a massive week, Roger, for earnings, and particularly in the U.S. And what we've seen after the bell yesterday, and as we see this week, some pretty strong results coming out, particularly from the larger tech companies. Google, Alphabet absolutely crushed it. Really strong growth in revenues, profits. Amazon, Meta, Microsoft also beat on expectations. But you're seeing them trade a little bit softer today, mainly because investors are questioning whether their massive investments in AI spending will justify a return on that investment.
And how do you see people react to that? Do you see them pulling back, or are they willing to wait, or are people running out of patience?
No, I think ultimately we're seeing an acceleration in AI infrastructure spending and investment. And I would say that overall the sentiment is fairly reflective of the fact that, because these companies have profits, have revenue, have stable balance sheets, this trend is still likely to continue with some stability backed behind it. But again, we're going to want to see a couple quarters from now and continuing justified results from those investments. And you're seeing those investments going into the semiconductor, the chip makers, and they're also reporting strong earnings. So the underlying fundamentals are still relatively strong. But again, at some point, you need to see that proof in the pudding.
And was there a clear winner from the earnings yesterday of those four? And is that just for the moment? Because who knows what the next quarter will bring?
So far, Google Alphabet has had the strongest return on investment in the share price today, reflecting their strong results. Over $109 billion of revenue growth, which is about 22% year over year, very robust. And they raised guidance for AI spending over the next several quarters. And I think that AI spending is really the story of the day. We're seeing hundreds of billions of dollars being invested in that space. And again, investors are going to want to see the results from that investment.
All right, Miley, we have to wrap it up there, but thank you very much for joining us.
Thank you, Roger.
Miley Wong is a senior wealth advisor and senior portfolio manager at Wellington Altus Private Wealth. West Fraser Timber posting a first quarter loss and missed expectations. We'll dig into the numbers after the break. West Fraser Timber is in focus after reporting a first quarter loss with results hampered by duty adjustments despite some improvement in commodity prices. Joining us now to break down the quarter and what it means for the outlook is Keaton Mamtora, Director of Building Products Equity Research at BMO Capital Markets. Keaton, thank you very much for joining us.
Good afternoon, and thanks for having me.
Of the numbers, which one stands out the most to you from the first quarter?
Well, I think first off, I should mention that part of the duties that we see is related to non-cash prior period adjustments. So that's not really a reflection of current quarter results. So excluding that, underlying results in lumber actually looks quite reasonable in the context of weak market backdrop and lumber prices, which were quite depressed for most of last year. So we've seen some modest improvement in lumber prices through most of Q1. And to me, that jumped out the most in terms of the improvement that we saw in lumber.
Now, is that a reason for optimism for West Fraser moving forward then?
I think it's an encouraging sign against a backdrop, as I said, of housing, which is actually still quite challenged. And within housing, single-family new residential construction is the one that's come under the most pressure. Repair and remodeling side is relatively balanced. We've also seen a meaningful supply curtailments over the last couple of years in lumber, and that has helped to bring supply-demand balance in better balance. And that is what drove lumber prices higher through much of the first quarter. So it is a step in the right direction. Having said that, I do think that given housing is still in a tough spot, that we may still have to wait for 2027 to get to more normalized kind of earnings results in lumber and in other parts of West Fraser's business.
And what other potential headwinds looking forward would it be facing? I mean, tariffs are still, duty rates, they're still an issue.
It is. And to be honest, I think the bigger near-term issue right now is higher diesel costs and the impact on freight and transportation costs. And the other thing in their oriented strand board business is resin cost, which is linked directly to oil prices, and that has gone up meaningfully as well. So in the near term, higher costs, both from diesel transportation as well as resin, is a meaningful headwind.
Do you know how much of a pressure, how much those have gone up, the impact they're having?
Well, we know that at least in OSB, resin is about 20 to 25% of the cost of production. Most of these companies have contractual lags. They also are able to use different kind of resins, at least in the short term, to mitigate the impact. So we don't know the exact amount yet, but I think it's fair to say that it is meaningful enough to have an impact on performance.
All right, and bringing it back to some of the numbers, the company reported an adjusted EBITDA loss. How much of that is cyclical versus company specific?
Well, most of it is cyclical, but as I said, the EBITDA loss includes $114 million of prior period duty adjustment. So that is not something that is a current quarter issue. So if you strip that out, it's actually a positive EBITDA in the first quarter of 2026. And that number is more like $48 million. So it's a positive EBITDA after a pretty challenging 2025. So it's a step in the right direction.
All right, and some of the operations, the Blue Ridge Lumber Mill, it's back online after that fire?
It is back online, and it is gradually ramping up. So again, it will take some time, but it is moving in the right direction.
And how much of a dent did that put in, having it down?
Relatively modest, I would say, for the size of West Fraser.
And any other operational concerns for them right now?
I wouldn't say operational concerns. They are winding down their oriented strand board mill in Canada, so they are working through that. But that's against a backdrop of very weak new residential demand.
And just going back with the tariffs, are we seeing any movement, any direction on any of those for the softwood?
We did see preliminary duties get announced here in the last few weeks, and those are down about 10 percentage points versus what they are currently. And by the time they get finalized and the companies start to pay revised duties, that will be sometime in late Q3 or early Q4. And that's down about 10 percentage points from what it is today.
So some help, somewhat of a break.
Some relief from export from lumber duties. The tariffs are unchanged at the moment.
Okay. All right, Ketan, thank you very much for joining us today. We appreciate it.
Thank you.
Ketan Mamtor is Director of Building Products Equity Research at BMO Capital Markets. Well, big tech earnings are driving today's market conversation, from AI spending to cloud growth and capital discipline. Up next, we'll break down what it all means for investors. Investors are digesting a wave of big tech earnings today, with results in from Alphabet, Microsoft, Meta, and Amazon, with Apple set to report after the bell today. Let's break it all down with Gil Luria, Head of Technology Research at D.A. Davidson. Gil, thank you very much for joining us. A busy, busy day.
Indeed. This was the biggest earnings day ever. $12 trillion of combined market cap reported yesterday. But I would say overall it was a good result.
Overall, good. So let's break it down individually. We'll start off with Microsoft. Azure growth reaccelerated, but capital expenditures also up.
Yeah, so Microsoft has a more than $100 billion Azure business, growing 40%, and they said it was going to accelerate in the second half of this calendar year. So they're doing very well. Overall, growing mid to high teens revenue and earnings. But they did need to increase their CapEx, interestingly, not to build more data centers, but to pay more for things like memory and CPUs and other things that go into data center. The cost of those items has gone up a lot, and Microsoft's going to have to pay more for them. And that's part of what investors were reacting to today, is that they love the revenue growth. They don't appreciate that CapEx is growing even faster.
And is it a big increase? Do you feel it's a manageable increase?
It's very manageable. Memory prices won't go up forever, but incrementally it's more spend. Importantly, Microsoft is doing a very good job of balancing that investment. They're building some of the data centers themselves. They're offloading some capacity to some of the neo clouds, and they're being very thoughtful about this investment. And again, the proof is they've accelerated revenue growth, not just in Azure, but overall for the business, while maintaining their very high margins, which is to say they're getting a good return on that investment. It may not be as good as they want so far, but we're in very early stages of this investment. This is a business that generated nothing a couple of years ago. Microsoft talked about it generating more than $35 billion directly from AI this year. So that there is a good return on investment. It'll just get better from here.
All right. Amazon next. Strong cloud results, especially among web and AI services. Your thoughts there?
A similar situation. Very good growth. Growing $140 billion business by 27%. Again, an acceleration. While the retail business having the best growth since COVID is a very good situation for Amazon. But same thing, investors are reacting to the fact that there's more investment needed. And they're also reacting to the other big hyperscaler that reported, Google, having even better results. And so by comparison, Microsoft and Amazon doing well, Google doing a lot better.
All right. Let's talk Meta. Another step. They're moving higher, their stock right now. What are people liking about it?
So with Meta, the revenue growth also accelerated to 29%. That's actually faster revenue growth than any of the other companies in the category. But again, CapEx is growing faster and OpEx is still growing faster. And so their guidance for profitability next year, for this upcoming year, implies that they're going to have declining margins. Investors didn't like that. They don't want declining margins, more CapEx, even if some of the return is coming in the form of faster ad sales. Investors want more discipline from Meta. are quarters and years where Meta is more disciplined. This is not one of those years. This is a year where Mr. Zuckerberg is going all in. He wants to invest as much as he needs to in the models and in the compute infrastructure in order to make sure that if they don't win, at least they'll be close to the top.
All right, and bring back to Alphabet. Your thoughts there?
Yeah, the saving the best for last in terms of these four. Their cloud growth accelerated from 48% to 63%. So faster, a lot faster than Azure and AWS, much more of an acceleration. Things are really coming together there. Not only is their Gemini product gaining prominence with consumers, but it's also now, for the first time just over the last few months, also participating in the enterprise market, which is a new thing, but it's driving activity for them. And then the cherry on top was that they're starting to sell their TPUs. Their TPUs are really the only competitive product to NVIDIA's GPUs. They used to only use it for internal purposes. Now they're renting out not only capacity, but they're actually starting to sell the chips. So that's another big value added for Google. And so that's why they were the star of the show last night.
All right, we're not done with you yet. Apple coming out after the bell today. What can we expect?
A victory lap from Mr. Tim Cook. He's completing his term as CEO at the high, right? And the iPhone growth is going to be 15-20% at least. A big upgrade cycle. That brings with it services. That brings with it peripherals and accessories. So they're going to have a great result. Tim Cook will get to celebrate his legacy, and we'll get some notion of where we're headed from the new CEO, John Turnus. But overall, a good quarter for him to retire.
Okay, and let's do an overall. Where do you think we're going to be in 12 to 18 months with AI and tech?
It's going well. The demand for AI is very significant. Consumers are using it for more things. Companies are figuring out how to deploy agentic solutions. We know this because OpenAI and Anthropic's combined run rate revenue is now north of $50 billion. Again, it was 0 2 years ago. We're up to $50 billion. They will both be the second largest software company and third largest software company within a year or two. So the growth there is spectacular because we're all finding use in AI. In a year from now, we're going to use it even more. The economic returns will be there. I would expect the build out of data centers to continue, and the companies that will do well are the ones we just talked about: Google, Amazon, Microsoft, not to mention the companies that sell them chips. NVIDIA, AMD, Broadcom, Micron. So we expect that to continue into next year, over the next 12 months, and for those companies to do well.
All right, we got to wrap it up there, Bigo. Thanks as always for your expertise. Appreciate it.
Thank you.
Gil Luria, Head of Technology Research at D.A. Davidson. Coming up, Capstone Copper has posted another standout quarter with record earnings and record EBITDA. We'll break that down with the CEO when we come back. Bausch Health is one of the best performing stocks on the TSX today. That's after the Canadian Pharmaceutical beat on the top and bottom line in its latest quarter, with revenue jumping 12% to $2.5 billion. Bausch also saw a surge in revenue in its Salix unit and its Solta medical segment. The company also reaffirmed its 2026 outlook. Shares of CP Kansas City are seeing gains after the rail operator maintained a positive full-year outlook and saw growth in overall volume. Analysts are also noting strong performance in operations and service and productivity. Downside, CPKC posted lower than expected profit and revenue, reflecting weaker freight volumes and pricing pressures. The company says it continues to face macroeconomic headwinds. Shares of Ford Motor are sliding. The automaker posted higher revenue and profit that exceeded estimates. However, the company is warning of pressure from an unexpected rise in commodity costs and expects a $2 billion profit hit as a result. Now, on the upside, Ford raised its full-year profit outlook due to demand for high-margin pickups and SUVs. And a quick look at the markets. A nice rally going on for the TSX today. It's up more than 1.5%. And south of the border, similar situation. Lots of green there as well. The S&P 500 up by 0.7, the Dow by 1.5, and the Nasdaq by 0.5. Capstone Copper is out with another strong quarter, delivering record earnings and a sixth straight quarter of record EBITDA, riding strong copper prices and improving operations. For more, we're joined now by Cashel Meagher, President and CEO of Capstone Copper. Cashel, thanks very much for joining us.
Thanks for having me. It's great to be here.
Six in a row. How much of that is performance and how much of that is pricing? What did you do there?
Yes. Sorry, I missed that.
For the 6 consecutive quarters of record EBITDA,
Yeah.
How much of that performance is pricing? How much of that is structural improvement?
Yeah, a little bit of it is pricing. You know, obviously there's been a super strong move in copper over the last year. But really, you know, a lot of it has to do on what we're building off of and the improvements at the individual operations here at Capstone Copper. We reset sort of the expectations around guidance at the beginning of this year, and actually some of our sort of high cost producers actually did better this quarter. For instance, our highest cost producer, Pinto Valley, sort of had their best cost, and we're developing a trend of creating margins there over these last 6 quarters also, as well as reflected in the EBITDA. So it's been a real journey for us. We've had operational improvements through operational excellence and our asset management framework, but so too we're taking advantage, obviously, with the higher copper prices. And Capstone Copper, that's what we're leveraged to. We're leveraged to about 95% of our revenue is copper. So we're really a pure copper play.
All right. And you mentioned Pinto Valley. What about Mantos Blancos? Mantos Blancos. My Spanish is terrible.
Yeah, Mantos Blancos has been doing great. It too underwent an asset management framework and operational excellence program. It's now sustainably over the last 3 quarters, meeting the throughput expectations of what the plant's capable of 20,000 tons a day. So that's been working great. The team there has done a terrific job. This year, we have a slightly lower grade, but we reestablished the higher grades in 27 or 28. So when we look 12 months out, there'll be quite strong margins coming out of that operation with now its sustainable throughput that it's achieving. It too has a great future associated with it. We have some brownfield expansion opportunities there where we can add another 7,000 tons a day of throughput. We need to go through a Chilean permitting process there, but we're looking forward to this new CAST regime who says they're going to streamline brownfield operations permits. So rather than looking at the full 2 years, we're very hopeful we can accelerate that process such that we add another 15,000 tons of copper per annum out of that asset.
So does that give you some optimism that you can hit your guidance for 2026 if that's sped up?
Yeah, so far, Mantoverde is our flagship operation, and we did have some labor action there for the first 5 weeks of the year. Our team successfully negotiated with that particular union, and we're back operating. We've had really strong operating results out of that asset, which is sort of our highest grade, highest throughput, and highest copper producer. We're also undergoing there an expansion to the operation where we're adding what we call Mantoverde Optimized, and we're moving the throughput from 32,000 tons a day of ore to 45,000 tons a day of ore. That tie-in happens late August, early September of this year, and moves that production up, another 20, 30,000 tons of copper per annum. All the operations, Cozamin, Mantos Blancos, Pinto Valley now is improving quarter over quarter, and we had very strong results out of Mantoverde. Outside of the strike, it was meeting its operating guidance. And certainly what we've seen to date at Mantoverde for April, we're achieving around 38,000 tons a day, which is much higher than its nominal throughput of 32,000 tons a day. So we're really looking forward to maintaining sort of at the median or the higher end of guidance for our forecast to the end of the year.
And for 2030, do you think you can hit your target for that? That's pretty optimistic.
Yeah, and I mean, that's super important. That's bringing on Santo Domingo. We have a few brownfields operations, but really I look at the Santo Domingo operation, which is located some 30 kilometers from Monteverde, in the Copiapó district of the Atacama in northern Chile. We just executed over the last 3 years at Monteverde Development Project, where we brought on a sulfide plant capable of the 32,000, as I mentioned, expanding to 45,000. Now we're going to bring on a plant at Santo Domingo with the same project team that executed on time, on budget at Monteverde, overlapping with the COVID pandemic. So a very strong team. That's complemented with a senior executive, myself, and some of the other members who have delivered copper projects over the last decades. And so too on our board of directors, we have experience delivering projects on several continents over the last several decades. So we have a very strong team. And I think the important thing to recognize about Santo Domingo is because it's only 30 kilometers away and it's at a sort of elevation that's very reasonable, 900-meter elevation, about 70 kilometers from the coast. This is a very low-risk project to bring on, and that's what meets our ambitions of getting to sort of 375,000 tons of copper consolidated out of Capstone by 2030, as you mentioned. And so we see ourselves going to that major project FID in the fourth quarter of this year.
All right, I just want to jump in with one more thing. Diesel, sulfuric acid, you flag those as possible headwinds. How much, and how are you trying to deal with them?
Yeah, I think it's there are different stories for different places in the world. It's all about what your logistics to supply are. For us, we're sort of in the Americas loop. So it's not a question of supply to us. It's a question of cost. And there's no doubt we've seen over 100% escalation in cost to those unit prices versus what we thought we were entering the year at. Nevertheless, the overall impact to our EBITDA or to, let's say, our cost per pound for the remainder of the year at current spot prices would be in the order of 20 cents more on diesel. We would see probably 10 cents more per pound on acid. But we're also benefiting from an elevated spot price on some of our byproduct credits like gold and silver, which would bring that down by 10 cents. So if we sort of take the midpoint of our guidance somewhere around $2.60, we see ourselves at spot prices sort of being up around $2.80 if these prices persist by the end of the year, which takes us just north of the upper end of guidance we established. And that's principally because, as you mentioned, the price of diesel and the price of sulfuric acid. Okay, we have to wrap it up there, Cashel, but thank you very much for joining us. Thanks for having me. Cashel Meagher is president and CEO of Capstone Copper. Up next, the CEO of GFL joins us for a closer look at recent earnings and what the company is focused on going forward. GFL Environmental reported first quarter results today that came in ahead of expectations. The company says performance was driven by strong pricing, margin expansion, and continued deal making. GFL also raised its full year guidance, signaling confidence despite a more uncertain economic environment. Joining us now to talk us through the results and what comes next is Patrick Dovigi, founder and CEO of GFL. And Patrick, thank you very much for joining us.
Thanks for having me.
Some good numbers, revenue, adjusted EBITDA, adjusted free cash flow, all ahead of expectations. Your adjusted EBITDA margin, 29.1%, highest Q1 in company's history. What went right for you?
I think it's just been a culmination of a lot of things, particularly just things we put in place really over the last couple of years and investments we've made in the business. Particularly around some of the Canadian assets and extended producer responsibility, and then some of the self-help levers around pricing, procurement, and just rationalization of sort of corporate SG&A, et cetera. It's just, particularly over the last 4 to 5 quarters, you start seeing outsized margin expansion. And I think you just saw that roll into Q1 this year. And, I think things are just moving along as we had articulated previously. And I think you're just seeing it all come to fruition now.
And there must be some weak spots or things of concern?
Yeah, I think, listen, the macro economy and, the uncertainty, particularly both in U.S. and Canada, particularly around tariffs, and now sort of, global macroeconomic fears and just the uncertainty that's putting in people's minds on both sides of the border. And I think, has slowed down construction and demolition volumes for sure. Little bit of uncertainty around rising interest rates, et cetera, where that's going to settle, particularly around inflation. But I think, that's the beauty of owning a waste business. There's not a lot that can materially move the needle, and we'll just react to whatever the situation exists out there.
The waste always has to be moved. Now, you described the business as resilient. Is that what you're referencing then, that there's always that for you?
Listen, it's a very durable waste stream. It's a very diversified income stream. I mean, we have multiple customers, whether it's commercial, whether it's residential, whether it's recycling, whether it's industrial volume. So I think, the business is very well diversified, which, yields the result that it does. And I think that's why you own waste, for not having a lot of volatility in up cycles and down cycles. And, I think we're just proving out that thesis as we continue moving forward here.
Is that what gives you the confidence with the challenges of the macro?
Yeah, I mean, we raised guidance. The M&A environment continues to be, very well at the same time. So I think that gave us the confidence. I think from our perspective, commodities have bottomed out here, and we think there's upside from commodities moving out in the back half of the year. So all of those things together have, given us the confidence to be able to raise guidance. And obviously with the predictability of our revenue stream, again, gives us that incremental confidence as well. Now,
one of those M&As, Secure, you're calling it highly complementary. How do you see it fitting in? And I know it hasn't gone through. Not everybody's happy with this deal, though, are they? Some of your shareholders.
Yeah, I think it was an education process the first two days of the announcement. That being said, I think there's been the tides have turned, and now our investor base knows it. I think when you look at these assets, again, they're very highly complementary in a market where we've been operating for almost 16 years now. And these are impossible to replicate assets in what I believe is going to be the growth engine for Canada for the next number of years. I think Canada, particularly with this government and the Liberals and the Carney government, have really doubled down on Western Canada and creating, making Canada an energy superpower. And, I think if you've seen some of the transactions being announced over the last week or two, I think that just further bolsters our view on Western Canada, again, low-cost producer in an environment today where, energy is important and energy at home is very important. And there's going to be a lot of investment made. And I think when you look at oil moving potentially from 5 to 6.5 million barrels a day over the next, number of years, I think that puts us in a very good position to be able to acquire these assets that are high margin, great free cash flow generators, and great barriers to entry into that market, particularly in a regulatory environment, Canada, that's very challenging. So to be able to get our hands on these assets, put together with our assets, I think it was going to yield exceptional results over the coming years. And I think when we look back on this in 6 or 9 months, I think our investors are going to be very happy that we took the leap of faith and made this acquisition, as we've done for the last 20 plus years. So these and other future acquisitions, are we talking in the near term? Could you see some more coming down, or is this a little off in the future still? No, I think from our perspective, the lion's share of what we're going to do is in traditional solid waste. This Secure business will represent, sub 10% of our overall revenue stream when we go into 2027. And our expectation is that we'll just continue doubling down on the markets where we're already operating in, where we can drive the highest returns on invested capital. And this will just fit into that, big puzzle that we have both in Canada and the U.S. All right, and you've moved the offices or the executives down to Florida. How's that going now? You've been down there, 4 months? Yeah, I think it's been great. And listen, we're still a Canadian incorporated company, so that hasn't changed. We have to make a corporate head office change for the simple reason that we want to get access to the U.S. indices and get U.S. index inclusion. So today we should get, later in the day, there should be an announcement on sort of the Russell and whether we were included in the Russell. But, I think that was the biggest change for the move, but we're still in a Canadian incorporated company.
All right, and just one last question on anything new into the police investigation, into those, you had those 2 arson fires at your place, the gunfire, anything new from the police on that?
And there's been multiple arrests over the last 2 to 3 weeks, which we're thankful for, the hard work of the Toronto Police, York Regional Police, and Halton Police. And, I think the investigation continues to be ongoing, but we're thankful for all the hard work they did and, hopefully putting that chapter behind us.
All right, Patrick, thank you very much for joining us today. We appreciate it.
Thank you so much.
Patrick Dovigi is founder and CEO of GFL Environmental. Still ahead, today's market movers with Bloomberg's Matthew Griffin. Joining us now for some movers south of the border is Bloomberg Equities reporter Matthew Griffin. Matthew, how are you?
Roger, I'm doing great. Just getting through earnings season. How about you?
It's been a busy one, hasn't it? Especially these couple of days right now. Let's get out of earnings. We're talking to Eli Lilly and a big obesity drug surge.
Yes, so that surge in demand for obesity drugs has fueled a higher outlook from the drug maker and is helping alleviate some concerns on Wall Street about their ability to make money in this market, especially as companies compete on price. So Lilly said that they now see revenue up to $85 billion this year and adjusted earnings per share up to $37. That's all US. That's higher than previously expected. The increase surprised Wall Street because, once again, there had been concerns not about consumers' desire to take these drugs, but about the competition on price for drugs such as, for example, Mounjaro from Lilly, which is approved to treat diabetes. And what's going to be coming online is now a new weight loss pill from this company. However, they say demand is holding up. We don't have hard numbers for the pill yet, but they say demand is strong before they even started marketing for it. And of course, that's all flowing into this outlook we're seeing. So we're getting a bit of a relief. Stock had lost about a quarter of its value from an all-time high, now up more than 10% today.
Yeah, I imagine people will want to choose a pill over a needle any day, won't they?
You know, it's actually an interesting question. It is easier. That being said, the injections, it can vary, but are often required. You often have to take them less often than the oral forms of these drugs. So there actually are questions about consumers' ability to stick with both for different reasons. And right now, though, it seems like, again, demand for both is really strong.
All right, let's get on here. Caterpillar, I always laugh when we talk Caterpillar and AI, because they almost seem like the antithesis of each other.
Yes, well, Roger, AI is a term that not only comes up again and again talking about the broader U.S. stock market, but has become more and more closely linked with the stock story for Caterpillar. Of course, the heavy machinery maker is known for construction equipment, backhoes, bulldozers, that kind of thing, but it also sells power generation equipment, and that unit has been really quickly growing. That continued in the most recent quarter when power equipment sales were up 41%, helping contribute to better than expected quarterly results. At the same time, you have the construction business strong as well. Their construction equipment sales rose 38%. That had been a business that had had some softness before. And all of this also allowing the company to raise its outlook for sales and margins this year and to get more ambitious about the future. They now plan to triple their capacity to manufacture these large power generating engines. They had just in November laid out plans to double that capacity, so that's seen as a bullish move. This stock, it's up also double digits today and now more than 55% this year.
All right, and Royal Caribbean, you've got about 15 seconds. Go.
Royal Caribbean cut its outlook, but less than feared. Signs demand's holding up in the face of the war. Stock still down 13% since the war started, but getting a bit of relief today.
All right, you got 7 more seconds. What else do you want to add on that?
Well, we've seen mixed results from, for example, hotel company, Hilton not as good, Hyatt better. Royal Caribbean put one in the win column for the travel industry today.
All right, now we'll wrap it up there. As always, Matthew, thank you for joining us. Bloomberg's Matthew Griffin. And that wraps up this edition of Trading Day. Have yourself a great afternoon.